Welcome to the Deep Dive. Our mission today is all about convergence. We're going to synthesize the stack of sources you sent over articles, research, notes, all of it, to really map out the stock market's current, let's be honest, extremely lofty trajectory.
It is definitely lofty.
And we're looking at the very specific headwinds that analysts are predicting for 2026.
Right.
And when you lay all these sources out, two massive risk factors, they jump right off the page.
They really do.
The first one is a series of very explicit warnings from the Federal Reserve about market valuations. And the second is a predictable and often pretty painful historical pattern tied to U.S. midterm elections.
And look, we have to start by just acknowledging the elephant in the room. The market's been relentless.
Absolutely.
The S&P 500 advanced, 16% in 2025? That's the third year in a row of double-digit returns.
The third, it's a huge winning streak.
A huge winning streak. But the sources we're looking at, they're not just suggesting the streak might end. They're making a case that history and the current metrics, well, they make a downturn in 2026 a pretty high probability. We need to figure out why.
Okay, let's unpack this. And let's start right at the top with the Federal Reserve. They are normally so measured with their language, but their recent warnings are anything but subtle.
Not subtle at all.
It really kicked off back in September. Fed Chairman Jerome Powell, he made a very direct public statement. He said, by many measures, equity prices are fairly highly valued.
And here's the kicker.
Right. The S&P 500 has kept climbing since he said that. So if they were highly valued then...
They're even more stretched now. By definition, you're paying more today for the exact same thing you could have bought in September.
Exactly. And this isn't just Powell. This concern is, woven into their internal discussions.
It is. The official FOMC meeting minutes from October they were strikingly clear. Participants commented on stretched asset valuations. And several of them flagged, and this is the quote, the possibility of a disorderly fall in equity prices.
Okay, let's pause on that phrase, disorderly fall. It sounds technical, but what does that actually mean for you, the listener, the average investor?
Well, it's the opposite of a slow, controlled decline. When the Fed uses a word like disorderly, they're talking about a fall that's driven by panic.
Not by fundamentals.
Not at all. It's fear. It means prices drop so fast that buyers just vanish. The market function itself starts to break down, and the selling just feeds on itself. It's what happens when confidence evaporates. And the Fed is worried that these valuations have built so much risk into the system
that if any little thing goes wrong.
Precisely. If a negative catalyst hits, the response won't be rational. It will be sudden, and it will be driven by fear.
And the warnings didn't stop there. Fed Governor Lisa Cook echoed that in November. She said she saw an increased likelihood of outsized asset price declines. This isn't just one or two analysts. This is an institutional warning.
It's the whole U.S. central bank. And Governor Cook, she tied these fears to a hard number. She referenced the Financial Stability Report, which warned the S&P 500's forward price-to-earnings ratio, the PE ratio, was close to the upper end of its historical range. And that specific metric, that's the key to understanding the fragility of the market right now.
This is where it gets really interesting because the sources give us the exact number. According to Yardeni Research, the S&P 500's forward PE multiple is currently 22.2. So for someone who isn't tracking this daily, break that down. Why is 22.2 the flashpoint?
So think of it this way. The PE ratio just measures how much you are willing to pay today for every dollar of profit a company is expected to earn in the future. The forward PE uses the expected profits over the next 12 months. So a PE of 22.2 means you're willing to pay $22.20 right now for $1 of expected earnings.
And how does that compare to normal?
Well, that's the key. The 10-year average for this ratio is 18.7.
So you're paying almost $4 more.
You are paying almost $4 more for the exact same dollar of expected profit. That 22.2, it's not just a premium. It implies this extreme optimism, maybe even complacency about the future.
So the big question is that optimism justified? Or is 22.2 a historical danger zone?
The sources make a very compelling case that it is a danger zone. If you look back over the last, say, 30 years, the S&P 500 has only traded above 22 times forward earnings during 3 specific periods.
Only 3 times.
And in all 3 cases, the outcome was a painful market correction. It didn't matter what the economic conditions were at the time.
Okay, let's walk through those 3 cases because the pattern is what's important here.
Right.
What was the first time?
The first one takes us back to the late 1990s. the dot-com bubble.
Okay.
The PE topped 22 as investors just piled into speculative tech stocks. The thinking back then was that the internet changed everything, that old metrics didn't matter.
Profits were for old-school companies.
Right. It was all about potential scale. They were paying, as one source put it, increasingly absurd prices. Well, the market eventually disagreed, and the S&P dropped 39% from its high by October 2002.
49%. A total wipeout.
It took years to recover from.
Okay, that feels like a really unique moment in history, a whole new technology. So how did the market get back to a PE of 22 in 2021? That was a completely different world.
It was, and that's what's so fascinating. In 2021, during the pandemic, the forward PE topped 22 again. But this time, the mistake wasn't valuing scale over profit. It was failing to anticipate inflation.
So investors were too optimistic.
Way too optimistic. They thought the supply chain problems and all that government stimulus wouldn't lead to, persistent price spikes. They didn't see the aggressive rate hikes from the Fed coming.
And when the Fed slammed on the brakes,
The correction was swift. The S&P 500 dropped 25% from its high by October of 2022.
okay, so we have the dot-com crash from tech mania and the 2022 correction from an inflation miscalculation. What's the third case?
The third is the most recent. The PE topped 22 again just last year, in 2024, right after President Trump's election. Investors were really focused on the positives.
Deregulation, tax cuts.
All of that. But they just profoundly underestimated how much disruption his administration's promised tariffs would cause.
And how did the tariffs specifically cause the drop?
Well, tariffs are often seen as just a tax on consumers, but when they hit corporate supply chains, they wreak havoc on future earnings projections.
Because companies can't plan.
They can't plan at all. Raw material costs become unstable. International sales suffer. Once investors realize the sheer scale of the trade disruption, that high valuation just crumbled. The index fell 19% from its high by April of 2025.
So this raises a really important question. Those three environments are wildly different. Speculative mania, an inflation shock, trade disruption. Is this just a coincidence? Or is there a real, genuine risk baked into that PE level itself?
If you connect the dots, the sources suggest the specific reason doesn't even matter. What matters is the fragility. A forward PE above 22 doesn't mean a crash is coming tomorrow.
Right.
But it means the market has priced in perfection. It means there is zero room for error. So when reality inevitably delivers a shock, any shock, the correction is severe because there's no safety cushion.
And the market is sitting right in that rarefied, historically risky air today.
Exactly.
That sets a dangerous foundation for 2026. Now let's pivot to the second major headwind converging with this, the brutal historical pattern of U.S. midterm elections.
The calendar itself is a problem.
It seems to be. If you just analyze the data, and we have data going back to 1957, that's 17 midterm elections, the average return during those years.
Exactly.
It's a miserable 1%, excluding dividends, just 1%.
And you have to compare that to the overall average since 1957, which is 9% a year. So you go from 9% to 1.
It's a massive drop-off. Midterm years are just historically tough for stocks.
And you can get even more specific. The sources point out that when a new president is in office during a midterm year, which is exactly the situation for 2026,
What happens then?
it's even worse. The S&P 500 has historically declined by an average of 7% in those years.
So not just a flat year, but a significant loss.
A significant loss on average.
So why? What is it about the midterm election cycle specifically that generates such poor returns?
The sources all point to one thing: policy uncertainty. Midterm elections almost always see the president's party lose seats in Congress. And that loss of power, it makes investors very nervous.
Because they're worried the president's agenda will get blocked.
Blocked, disrupted, maybe even reversed. And think about it from a business perspective. Corporate budgeting and big investment decisions, they rely on a stable regulatory and tax environment.
And you don't have that during an election fight.
You have the opposite. You have gridlock and unpredictability. So companies put big projects on hold. Investors who aren't sure what the rules will be next year, they step back. And we know markets hate uncertainty. They fall, or at least go nowhere.
Okay, so to recap, we have a year that typically generates just 1% on average, combined with one of the most expensive market valuations in modern history. That paints a grim picture for the first 9 or 10 months of 2026.
It does. But, and this is the important part, the good news is that this weakness, the political uncertainty, it's typically short-lived. The historical risk seems to be heavily, heavily weighted to the run-up to the election.
The campaign season.
The campaign season, when everything is up in the air, you can see this very clearly in the performance after the votes are counted. According to Parson Investment Research, the 6 months following the election, so November to April, that period has historically been the strongest of the entire 4-year presidential cycle.
Okay, the contrast there is just dramatic. So the market struggles to make 1% the calendar year of the election.
Right.
But what happens in the 6 months immediately after?
The historical average return for that post-midterm 6-month period, once the uncertainty is gone, has been a massive 14%.
14%.
14. It's this powerful, almost reliable bounce that happens once there's policy clarity, and it doesn't even seem to matter which party wins.
So let's put it all together. What does this mean for you as you look ahead? We have to bring these two big threads together, the valuation risk and the political headwind, to define the 2026 outlook.
And the synthesis is pretty stark. You have the stock market sitting at a forward PE of 22.2, one of its most expensive price tags ever. Analysts are warning that any shock could lead to a sharp correction because there is no safety margin.
And that extremely high valuation is running headfirst into the historical struggle of a midterm election year. You're basically stacking a high risk of a valuation correction on top of a calendar year that's already known for weak or even negative returns.
So based purely on the patterns in these sources, it is absolutely reasonable to assume the stock market could struggle or, to use the Fed's term, experience a significant disorderly fall sometime in the first 3 quarters of 2026. Now, these are historical trends. They're not a crystal ball.
Of course.
But they really emphasize how important context is when you're thinking about buying into the market at these prices.
You're buying into a market that is defined by major historical risk factors on multiple fronts right now.
Well, thank you for sharing your sources and letting us take this deep dive.
And here's a final thought for you to mull over, which is really the calculation you have to be making. Given that the S&P 500 has historically returned 14% in the 6 months immediately after the midterm election, that highly reliable bounce, how do you weigh the risk of a potential sharp decline in the first 10 months of 2026 against the strong historical reliability of that subsequent massive rally? That tension right there between the risk and the potential reward, that is the 2026 investment problem.